Welcome to an exceptional edition of Rebellion's educational series. We're going to explore the interest rate phenomenon that has absolutely curtailed markets in the last week or two. And we've got a legendary economist with us to help us through this. Joseph Brusuelas was the inventor of Bloomberg's economic report, the chief economist of Bloomberg, chief economist currently of RSM, really just brilliant guy I've been following now for several years online. Thank you so much for coming on.
Well, sure. No, thank you for having me on Rebellion Research.
So I know you've got a lot of background in the middle market and you really understand the heart of the US economy. And so what's going to happen with this recent run up in interest rates? Are we going to see a slowing in the US economy? Are we going to be okay?
Well, that's the interesting thing about when you're looking at, say, the real economy as opposed to the financial economy, right? Rates are at such historically low levels that you're likely to have a minimal impact on the backup, say, on the 10-year over the past couple months. So at the turn of the year, January 1st, the interest rate on the 10-year, the yield on the 10-year government security was at 0.91. It's trading anywhere between 1.4 and 1.5 over the last couple of days. Yes, big move, short period of time, means a lot if you're trading at, say, a fixed income desk, at an institutional investor, or you're a real money player. But if you're a long-term investor, or more importantly, if you're managing a business in the real economy, or you're a policymaker trying to create the conditions for a rebound in the US real economy, well, this isn't really the biggest deal, right? It just means that the US economy is beginning to reflate. That is, that near depression episode we had over a year ago, we've now moved beyond that. We still got some real issues and challenges in front of us, but it does look like the combined impact of fiscal and monetary policy and the gradual reopening of businesses across the economy will create the conditions for probably the strongest year of growth we've observed in the US economy since the late 1980s. And that's something to talk about.
No, that's very bullish. I mean, I'm worried about the jump in mortgage rates slowing the housing market, and you're talking about one of the strongest economic years in decades.
Let's talk about that, right? So I'm sitting here talking to you in Austin, Texas, right? And during the pandemic, we've all become, slaves to where we're at. What do I see here? Well, I see a city that's bursting at the seams, not building enough houses quick enough, which has caused prices to rise. 10 miles south of the city, Tesla's building its gigawatt factory. 10 miles north and west of the city, Apple is constructing its second campus. Okay, this place is going to boom for a number of years. You can buy a house, though, if you've got 25% down. You can get a 2% 15-year fixed mortgage rate. Okay. When we talk about housing and affordability and interest rates, it's important to take a step back and look at it in the broader context. 2%, you can pay 2% fixed 15-year mortgage, which means you can own your home in 7 years if you double that payment, right? I would say, yeah, we're off the bottom where we didn't want to be. We never want to go back to mid-2020, where the 10-year was at 0.6 and interest and mortgage rates looked like they were just going to go down to the floor, right? We never, ever want to be there. What you're seeing is a virtuous cycle beginning to take hold as we emerge from the near-death experience of the pandemic. I mean, we had the deepest recession we've had since the Great Depression. That shock that we experienced, I can measure these shocks in financial markets. I'm sure you'll be interested in this. When we finally saw the shock begin to show up in our financial conditions indices, we could see that it was near 7 standard deviations. Okay, it's not as bad as we saw in the great financial crisis, but that was because the financial crisis, the origins of it were in the financial sector, right? This shock wasn't. It was a public health crisis that impacted the real economy. So we surmised very quickly that shock was much bigger than what our data was telling us, right? We never want to go back there. We're just beginning to emerge from this. And it's going to take a number of years to get back to full employment, but you are going to see the economy take off. You're going to see rates move up. My target is 1.65% on the 10-year at the end of the year. And that would imply that we're going to move towards a 4% 30-year fixed mortgage rate, probably sometime in the middle of 2022. Okay, well, that's worse than 3%, which is what you can get now, but it's much better than what was happening prior to the pandemic. So it just, I suppose it depends how you look at it, but because you and I are data-centric people, right? We make decisions, business and portfolio decisions around data. I got to tell you, things look pretty good.
No, they do indeed. Sales have been quite strong in a number of U.S. industries that we cover. I mean, we break it down to about 230 sub-industries for our machine learning economist. And most industries are doing quite well. Of course, those that have been hit hard. But do you see everyone going back to work in the next 6 months, 9 months with herd immunity, whatnot? Do you see everyone going back to IHOP, sitting down like they used to?
Okay, well, a couple of things. Until we stick the landing on the vaccine, which is looking increasingly likely, the economy is not going to be fully recovered, right? We expect that to be late this year, early next year, when we're back to utilizing the full potential capacity to produce goods and services in the economy. Okay, so what does that look like? Well, the economy is not going to look the same as it did prior to the pandemic. It's just not going to be that way. There's going to be residual economic scarring in the aforementioned or the following labor markets. Where we had the problems were profoundly down market, largely among small firms, and then amongst some large firms that had exposure to leisure hospitality, transportation, retail, food and beverage, to a certain extent energy, although energy's clearly rebounded.
Yes, quite heavily.
Right. So when you look at the economy, I like to break it down by the ecosystems that are there.
Do you also, can I interrupt you, Joe?
Yeah, go ahead.
This energy rebound has been just immense. I mean, the mids, pipelines are up 2-3 times. Oil's now, over 60. We had Mark Fisher on, a well-known oil trader who believes that oil's kind of capped at 60. There'll be too much that comes out. I mean, do you agree with him? Bank of America just had $100 oil. Do you have an opinion on oil?
Yeah, sure. So I'm a member of the Wall Street Journal's forecasting panel, and I've got a year-end target around 65.34. That's my target for the year-end.
Really?
And my sense is, what we're experiencing is a little bit of rational overshooting, as we're.
That is the human way.
Right, that is the human way. As we revert to the mean, you are going to overshoot. It's almost always there, right? Oil should be moving between $50 and $60 a barrel. We'll move somewhat above that here, I think, at the end of the year, again, as the G7 economies reflate and then the emerging markets trail. You're just going to see that demand rise. Remember,
Sorry, Joe, let me interrupt you one more time. We've had 2 senior economists from other banks point to a slowing in China recently. Do you agree with that? Where are your feelings on China right now in the short term?
So the Chinese economy, I think, is slowing because they recovered first, right?
That's a great point. Great point.
So they'll be moving back towards their growth, and energy utilization means well before the United States. Look, the increasing demand on the margin in the oil market is clearly from the emerging world. As the advanced economies diversify away from reliance on fossil fuels, you should expect to see demand managed very carefully, especially in the OPEC countries. I think there's a real concern that the increasing or the acceleration in diversification away from oil, especially in the United States, especially in Europe, has made oil producers acutely sensitive to letting oil prices run up. The higher those oil prices are, the more attractive renewables become, right? I mean, here where I'm in Texas, we just had our grid failure for a lot of different reasons, mostly policy and regulatory inattention. But when you get out into the summer, wind power is going to supply up to 40% of electricity in Texas. Okay, this is something even 10 years ago, the most bullish proponent of renewables couldn't have even imagined. Well, we're here, right? So energy is going to be very, very interesting going on.
So don't we have to look at storing energy then for, times of said 2 weeks ago?
Right. No. So, from when I talk to the oil and energy professionals, they tell me we're at our near storage capacity, particularly circle back on that question on China. They're trying to build as much storage capacity as they can. And this isn't anything new. Prior to the pandemic, when the global economy was somewhat tight, we would see periodically stories about oil tankers being unavailable because they were simply sitting offshore full with nowhere to put it, right? So we'll see how this proceeds. But when we're talking energy, you're talking oil, you're not really talking the United States anymore. You're talking China and emerging markets, because those are the economies that are overly dependent upon oil. The most interesting thing about the United States economy is its sensitivity to movements in oil prices has declined significantly over the past 10 to 20 years.
I can imagine. I mean, I know we're not at 70% like Norway is, but we're getting there, and the desire for electric cars is immense. Plus, most of my students don't even want a car. It's amazing.
Right. It is. I live here again in downtown Austin. Many of my neighbors, again, don't have cars. They rely on Zipcar, Uber, Lyft, and all they need to do is go to the airport or get on the train station and they can move, right? So when you see GM and Ford, you see Jaguar, all making the point that they're moving away from internal combustion by 2030, 2035, they'll only be producing EV fleets. You really are observing in real time the great transformation of transportation and energy utilization here in the United States. Again, this economy is just accelerating and transforming at a very rapid rate, whether you're talking transportation or digital. This isn't your father or your grandfather's economy, nor should we be making policy as they did in the early aughts or 1980s.
That's a great point. You mentioned China's doing what it can to have oil, but what about water? China has a significant deficiency in well water, something like 2 to 3 feet on average versus 50 feet in the US. Do you see water wars occurring? That's something that T-Boone Pickens used to talk about. And I know it's maybe a little out there, but I was wondering if you had an opinion on such.
Yeah, it's a little out there. You'd expect to see some of the first tensions surface in the Middle East. When you go to China, what do you see if you're along the coast? Great big desalination plants, right?
Yeah.
Not like they clearly aren't signaling they know they have a problem. They do, and they're moving to address it, right? And desalination plants and other forms of exotic technologies to make water more available are clearly going to be part of the conversation, whether you're a policymaker, a businessman, or an investor. And that'll happen probably much quicker than what we think.
So you mentioned the emerging markets and their demand for raw materials. Do you see Latin America continuing its recent run up?
Okay, so Latin America is going to be challenging for some time. When I say, and then you need to break it down as what country you're looking at, whether it's Mexico, Argentina.
Well, I guess let's start with Brazil.
Yeah, Brazil's going to be a mess because of the political sector for a long time.
I know. I just saw they appointed a government person in charge of Petrobras.
That's right. So that's down. That's on the slide downhill. Once you do that, you're going to run into some problems because
it's not a good slippery slope,
right? And the president of Brazil, who ran as a market guy,
he did indeed.
Right-wing populist, and there's some fear that he's going to become addicted to spending. There's a long history of right-wing populism, inflation, and currency debasement in Latin and South America, and this is beginning to resemble that somewhat. It's still early, but investors are clearly concerned around both political, economic, and monetary risks in Brazil.
No, South America, like no other area, seems to always go towards populism, whether it's Venezuela at one point or Argentina, of course. It's a really interesting continent. A few
Well, when you
people.
have economic inequality like that, it's hard not to have both of the corner solutions, or what I call left-wing and right-wing populism,
Hmm,
become quite popular and actually almost exclusively become the sort of the duality in these political economies, right? Where it's just
no.
one or the other. There's no intermediate, and you tend to get these violent swings in terms of policy from left to right. And when you look at what happened in Venezuela with right-wing populism, you can't help but hesitate when you're looking at the evolution of the government in Brazil and think about the risks there.
Well, let's get to Mexico while we're moving to Latin America. What are your thoughts there?
All right, so Mexico clearly is going to come out of uh, the pandemic era economy, um, looking at stronger growth, but the instincts of the government there is not conducive to what I call a better composition of growth.
Hmm,
They've put too many constraints on the energy sector in Mexico. Mexico needs significant reform, needs financial innovation. They need private equity there. It's going to be challenging, I think, for the remainder of the president's term in Mexico. But in Mexico, you get 6-year terms in terms of the president, and the first 2 years have just been lost to the pandemic. The agenda now has changed, and we'll see if the government can adapt to that. One thing I do know, you're going to see tensions between the United States and Mexico abate.
really? Okay.
That,
Well,
we're just in a better situation now. And of course, the Biden administration is very quietly under the radar, reaching out to mend fences with its major trading partners, i.e., Canada, Mexico, of course, Europe, and Japan.
speaking of Europe, what are your thoughts there? Is it just Germany and France, or do you see more than that?
Well, it's the German economy that makes sense, and the French state. You know, they've had a devil of a time addressing the pandemic. They've got similar demographic characteristics to the United States, and they had a major pushback, especially in Germany, especially in France, on the government mandated lockdowns. They've had a devil of a time implementing the vaccine distribution, and it looks to me like 2022 will be the year of Europe, as opposed to 2021 being the year of the United States.
Understood. Awesome. Well, this has been a great show, Joe. You're absolutely brilliant and very kind to come on. I really appreciate it.
Well, thank you very much for having me, and I look forward to doing it again.
Yes, we love that. You stay safe during these crazy times and be well.
You too. Thank you. All right, we're clear.